It was a good day in the market, right? Markets were up about 24 points in the S&P. Not surprising. We talked about last week, after the sell-off, the market had gotten pretty oversold on a short-term basis. And you watch our live stream right now at realinvestmentadvice.com or go by our Facebook page, facebook.com/realinvestmentadvice. You can see our live stream right now. So you can see the charts. And over the last couple of weeks, the markets got very oversold, tested support right here at the 50-day moving average. And we talked about the fact that we really needed to hold there. Well, we did, and we got a little bit of movement up from off that. We got a nice bounce off of that. Now, we're going to come back here and look to retest these highs from June. This is something we said in our newsletter this weekend, that if we got a follow-through rally today, that'd be very likely we'd retest these highs from June. If we can get above that with some conviction, then potentially we could see a market that could retrace back to the old highs back from January. But it's a bit early to say that. Markets are extremely overbought now because of this sharp ramp higher. This has been on very light volume. It's been a very narrow rally. So we've talked about, being cautious here, holding your position at the moment until we kind of see how this thing works out. But this is good. This bounce off support is actually very good news. Again, it keeps intact a couple of things. One, this line of rising bottoms has been very good. The market's come down. It's continually established higher lows on this tower rally higher. The only real concern here is this continued run of resistance right here at the June highs that goes all the way back basically to March and February. So this is going to be a good bit of resistance for the market, but we are compressing prices here in this movement. So we're eventually going to get a breakout of this one way or the other. And again, if we can get a breakout to the upside here, that's going to lead us back to at least the old highs of the year back in January, which is going to be right around 2850, 2900. But also, too, if we get a break to the downside, then that's a whole different issue. So hopefully we're not going to get there yet. But one thing here is that we really have stayed very range-bound in this market, really going all the way back to earlier this year. Overall, really, the market hasn't done a lot this year at all. We've had a lot of price volatility, a lot of movement, but overall, really haven't gone anywhere. Now, one thing I want to say is, though, if we step back from this, and this is a daily chart, so you see lots of price volatility movement. We got a lot of price movement up and down here. But if we step back here and take a look at a longer-term chart, and look at it on a weekly basis, we get a much better picture about what's actually happening within the overall market. So what you see here is the very same thing. We have this declining period of tops here going all the way back to January this year, this rising level of bottoms, and this very compressed trading range that we have currently with prices. We need to get a move out from this. If we are going to make a move higher, we've got to break out of this trading range sooner or later. A break to the downside, which right now would be right around 2,700 on the S&P. We're looking at a pretty deep trough at that point, roughly around 500 points of downside before we get to any type of real supportive bottom. It's a big decline here because of the recent advance that we had back in 2016. We had that whole period of just solid advances. Basically every month was a positive month, but we got so far extended from long-term moving averages that a break here to the downside has a fairly big ability to draw a good bit out of your portfolio. So we want to pay real close attention to this, and there's not a lot of wiggle room here. We're at 2779 today, 2,700. So I mean, it's like 70 points of downside. You're threatened with a much bigger break, so we can eclipse that move fairly quickly. So don't dismiss just how fast that we can decline 70 points in the markets. It can happen fairly quickly. So, but a move to the upside gives us some more advantage. But again, as I said, we're very overbought on a short-term basis. So look for potentially some consolidation here. And if we do get a pullback that doesn't violate that support, that's going to be your opportunity to add some more exposure. And hopefully that should happen around the end of this month, maybe early August. And start setting us up for the end of a year rally. Once we get through the November elections, barring anything that goes kind of haywire, things should actually kind of open up for the markets. The big concern here over the course of the next few weeks, and something will be supportive to higher prices, there's a real possibility we could get out of this range to the upside over the next few weeks, and that's going to really be based on the strength of earnings. Now, we're about to enter into earnings season. We're going to get a lot of earnings reports. So if earnings come in better than expected, which they will because we've already lowered expectations enough for companies to get over it, we should have some decent bias to the upside through earnings season. What we're going to be watching for, though, and the thing the markets are going to be watching for, is over comments by CEOs about the risk of tariffs to profitability. And if we see a lot of companies come out, really start warning about tariffs, the impact to profits, are starting to see weaker than expected profit growth, there is risk to the markets. Again, we remain very overvalued at this point. And while earnings have been growing, they haven't been really reducing the valuation issue with the market. So the one thing we're really going to watch here over the next couple of weeks in particular is what the markets are saying about tariffs. One other thing about this, and we talked about this last week as well. If you take a look at what bonds are doing, we had a little bit of a pullback today, but not much. And what bonds have been telling us here as of late is that the whole story on higher rates and inflation, etc., may not actually come to fruition. So watch rates here. Bonds aren't really buying this idea that the trade war is behind us and we're off to the races. Bonds are telling us a little bit different story here, so keep a watch on that. We've got a big inflation report out on Thursday we'll be talking about. But overall, it's going to be earnings for the most part here over the next several weeks, really the next couple of months, as corporations start announcing earnings and really the strength of those earnings reports. But most importantly, it's going to be the outlook of what they say. The big risks are going to be coming with companies like Apple, Netflix, Facebook, etc., that have had really tremendous runs over the first course of this year. They've got very high marks that they've got to continue to boost out there in terms of subscriber growth, etc. Twitter, as an example, just purged 20% of their users, 70 million accounts they just purged that were basically fake accounts. That's going to really get people looking at these other subscriber-based companies like Netflix and Facebook and others that claim, hundreds of millions of users. How many of those are actual real active users versus what, like Twitter was saying, 20% of our users are basically fake. So again, keep a watch. There's a lot of stuff that's going to be happening this earnings season, and then next quarter comparisons start to get very tough on an earnings basis. So we didn't see a lot of advance out of stocks based on earnings reports going into the first quarter. So we may not see a lot of impact from earnings in the second quarter, but we're going to pay close attention to it. All right, quick break. We're going to come back. I've got a couple of stories to get into. We'll take your questions as well. You're listening to the Real Investment Hour. I'm your host, Lance Roberts. Don't go away.
Follow Lance on Twitter @Lance Roberts or go to realinvestmentadvice.com.